Good morning, everybody, and thank you for joining us for this event, which is the latest in a suite of outputs that we're putting out as part of our pensions review. So the pensions review, very big project at the IFS, been running for just over 2 years now. It's being funded by the Aberdeen Financial Fairness Trust, for whom we're very grateful. And what we're looking at is the risks that people face around their retirement saving, and can they be better helped to accumulate the right amount for retirement and be helped through retirement in terms of using those resources. And it's that latter part that we're going to look at today. So there's always much attention about whether people are saving enough for retirement. We want to now look what happens post-retirement and how we help people use their resources through retirement to try and get to that Goldilocks moment where they're not running down their resources too quickly, but they're also not running them down too slowly. So this is a major output of the pensions review, very important issue to help people have good retirement resources that they use well. I should say that the main output of the pensions review, a report where we bring together all of our recommendations to date on all aspects around state pensions and private pensions, and also the benefit system. That's happening on July the 2nd. So there'll be an event there. Do put that in your calendar. Do look out for the reports that we publish on that day. So the focus of today is on decumulation. I'm very pleased that two of my colleagues who've worked intensively on these reports are going to present. Firstly, we'll have B, who will set the scene, describe the evidence base around what the challenges are in this space. And then Jonathan will present on what solutions we see, what we think what reform is needed to help people make better decisions. And then after that, we're very pleased to have Paul Todd from Nest as one of the country's largest workplace pensions providers. They've done a lot of thinking about how to support employees and the self-employed in this space, and we'll be getting his reflections on the situation and our recommendations. That's all going to take 35 minutes or so. Then we'll open up to a question and answer session. If you wish to ask a question, you can do that using the Slido website. You can find a link on the IFS events page. It should be in the email if you signed up to this event. Just click on that link. You can add your questions there. You can also upvote any questions that others have asked that you think are particularly interesting or pertinent. That will make them rise to the top and make it more likely they will catch my eye for the Q&A session. So that's all from me. I will now hand over to B, who's going to give the first presentation.
Thanks, Carl, and good morning, everyone. So I'll be talking today about what we know about how people are drawing down on their pensions at present, how they might do so in future, and about the sorts of risks that they face in doing so. I'll first tell you that, while most current retirees are making what we might call relatively low stakes decisions over their DC wealth, by which we mean defined contribution pensions, pots that aren't guaranteed to provide a lifetime income, the importance of decisions made over DC wealth is set to grow due to the rising value and prevalence of defined contribution pensions. Next, I'll talk about why that rise is coming in a concerning context where the flexibility with which DC savings can be accessed has increased, but many are still not getting any sort of help, whether in the form of information, guidance, or advice, at various key stages of decision-making about their DC pension. And finally, I'll talk about the range of risks that are faced when drawing down on defined contribution wealth through retirement in particular, and the fact that these risks are increasingly faced by individuals. And overall, this all comes together to mean that there are multiple challenges for policymakers looking to ensure good outcomes. And then Jonathan's presentation will talk a bit about what we think might help with this environment. So first of all, I'll talk about the increasing importance of defined contribution pension wealth with its rising prevalence and value. To start off with, we know that an increasing share of people are reaching retirement with at least some defined contribution pension wealth. So here I'm showing you the proportion of people in their late 50s and their early 60s with at least some defined contribution pension wealth over time. You can see that this share has risen pretty markedly, so rising from around 44% of this group back in 2006 to 7 to more like 59% in 2021 to 23. So this rise in the prevalence of defined contribution wealth has been happening in the past. And then in the future, we expect that the value of defined contribution wealth at retirement will be rising. So we can see how much DC pension wealth those currently in their 50s and 60s have and how much they're accumulating. And we can use this to project their wealth at retirement. And we think that median pension wealth at retirement is set to rise from around £74,000 among those who are born in the early 1960s to more like £131,000 among those born in the late 1970s. So there's pretty substantial rise over the next few decades in the amount of DC pension wealth with which people are reaching retirement. And we can see that this rise is happening at higher levels of pension wealth too. So I'm showing you the 75th percentile of DC pension wealth among those with at least some DC wealth. You can see that we expect this to rise from around £215,000 for those born in the early 1960s to more like £300,000 among those born in the late 1970s. So pretty substantial rises here. As I said, this is over the next kind of few decades, so a cohort of people really, who, while they've been affected by policies like auto-enrollment, whereby most private sector employees were enrolled into a DC pension, they're less likely to have been saving into a DC pension for their whole working lives compared to those younger than them. So in the future, as people who've been auto-enrolled into a DC pot for the whole of their working lives reach retirement, it's likely that pot sizes will become substantial. And that's going to be the case, we think, even among low earners. So here I'm showing you DC pension wealth at each age for someone who works each year between age 22 and 66. This is someone making auto-enrollment minimum pension contributions and who's opted into their pension for the whole time. You can see that someone who starts off by earning £18,000 might accumulate a pot of around £150,000 if they stop working at 66. So, lots of assumptions here, and this is very much illustrative. But the point here is that these sorts of people are going to reach retirement with much more substantial pots of DC wealth than we've seen previously, about which really complex financial decisions must be made. So we've seen this rise in the prevalence and the value of DC pension wealth, and we know that this is set to rise in the future. But at the same time, we've seen a change in the way in which this sort of pension wealth can be accessed. So before 2015, the vast majority of people had to annuitize at least 3/4 of a DC pot, so providing a lifetime income from their pension savings. But in 2015, the pension freedoms reform meant that they were allowed to access their pension wealth flexibly. And this, unsurprisingly, has meant that people now access their wealth in a really wide variety of ways. And to get at this, we can look at the ways in which pension pots were first accessed in 2023 to 24. Here I'm showing you that only 9% of pots first accessed in 2023 to 24 were used to purchase an annuity, so a real decline in the prevalence of annuity purchase. Another, around 40%, were used to purchase a drawdown product or to access in some other sort of flexible way, with more than half of DC pension pots fully withdrawn in cash. So in general, people are kind of shifting to ways of accessing their pensions that require more complex decision-making for longer through retirement. There's also much more variety in general in terms of how people are choosing to access their pensions. And alongside this variety and the types of ways in which people are withdrawing their pensions, and the fact that we see this shift towards arguably more complex ways of accessing your pensions, we know that most people, when first accessing their pension pots, are not using any sort of regulated advice or government guidance. So here I'm showing you the proportion of pots first accessed in 2023 to 24 that were accessed by someone who was using regulated financial advice. You'll see that this was less than a third of total pots, at around 31%. It was much higher for the largest pots that were being accessed, as we might expect, but still represented less than 2/3 of the most valuable pots, worth £250,000 and above. Here you can see that around 10% of total pots were accessed by someone using government guidance from PensionWise, and the rest of pots accessed by someone who hadn't used either. You can see that here that this was around 60% of all pots, but even among the most valuable pots, 29% were being accessed by someone who hadn't used advice or guidance. And this is made particularly concerning because we know from other sources that there are really very low levels of information about pension choices or about retirement among people in their 50s and 60s, and very low levels of planning as well, with a substantial share of people in their early 60s and even who have relatively high levels of DC pension wealth without a plan for how they'll use their largest pot of wealth. And we can think about how people are accessing their pots in a bit more detail, and we'll think now about the set of people who are accessing their pots flexibly through drawdown, making regular partial withdrawals from their pots. And here I'll show you the rates at which people are withdrawing their pots. And something to take away from this is that rates of withdrawal vary really very considerably. So here I'm showing you the share of pots that were withdrawn at either less than 2% or between 2 and 4%. You can see that around 30% of pots were being withdrawn at rates of under 4%, so relatively slowly, in thinking about in terms of rates that would exhaust a pot at or around death. But that was much higher among the most valuable pots. So I'm showing you here that around more than half of the most valuable pots were being withdrawn at these sorts of rates. Another around 30% were being withdrawn at rates of around between 4 to 8%. And this leaves the rest of pension pots withdrawn at rates of 8% or above. And you'll see here that this is much higher for the least valuable pots. And as I said, there are real differences here, and we might perhaps be concerned, particularly in the context of the previous slide, that those withdrawing particularly slowly or fast might not be making decisions that are best for them. Of course, one thing driving the slow rates of withdrawal among the most valuable pots might be the inheritance tax treatment of DC pensions, where at least currently these are tax favored. We can look at the rate at which other non-annuitized wealth is drawn down to see how drawdown for wealth that doesn't get this favored inheritance tax treatment looks. And here the thing to take away is that financial wealth is not drawn down fast. So here I'm showing you mean net real financial wealth by age, separated by birth cohort to ensure we're not capturing kind of generational differences here. You can see that real financial wealth is pretty flat by age, so not being drawn down fast, if at all. And we see a similar pattern looking at median net financial wealth. So a picture here of varied access to pension pots alongside few people using advice or guidance. And finally, we know that those who are making withdrawals from DC pots face a range of risks, and these are vastly increased by pension freedoms, so there's increased flexibility with which people can access their pots, alongside the fact that annuitization has fallen quite substantially. So the first risk is what we call longevity risk, so the risk that people run out of private resources because they live longer than they expect to. And this is generated by the uncertainty surrounding lifespan, which, among other things, means it's difficult to know what a sensible strategy for drawing down a pot of wealth is. And to illustrate this, we'll think about 67-year-old men in 2024, although the pattern holds across sexes and ages, really. Half of this group will live to be 86. We might think that this sort of number might inform a strategy for the speed at which people choose to draw down their pension wealth. But here I'm showing you a survival curve, which gives the proportion of these men we expect still to be alive at each age. You'll see from this that there's really quite a lot of variety here. So a quarter of men will die by age 79, so might want to draw on their wealth really much faster than if they were using 86 as a vantage point. But at the same time, a quarter of men will live longer than age 92, so drawing down on their pension wealth very fast could be disastrous for their living standards. And while people do, of course, have some information about where they might potentially place on this curve, so knowing private information about their health, for example, there's really a lot of uncertainty here, making it hard to choose a sensible strategy for drawing down pension wealth. And something that we can note is how this risk actually increases at relatively older ages, which Jonathan will return to when we discuss our policy suggestions. And to illustrate this, we can think about the share of men who will live 50% longer than their median life expectancy, which is a bit of a guide to the risks associated with choosing a rate to draw down on pension wealth. So 14% of 70-year-old men will live 50%, more than 50% longer than their median life expectancy. But that almost doubles to 26% of 85-year-old men. And it's much harder to set sensible drawdown rates when the probability of living much longer than the median life expectancy is higher. So this sort of relative longevity risk increases as people get older within retirement. So that's longevity risk. Another key risk that people face, particularly when actively drawing down on their DC pension pot through retirement, is the uncertainty over what returns they'll receive on their pension savings. Differences in asset returns can have very important effects on the age at which a pension pot might be exhausted. And to illustrate this, we'll assume that someone starts drawing down on their pension wealth at 67, and we'll think about two scenarios: the rates of return at 3% or real rates of return at 0%. And first, we'll think about those who withdraw from their pension pot at an initial rate of 4% before keeping the amount withdrawn constant in real terms each year. And here I'm showing you that if real rates of return at 3%, this group might exhaust their pension pot at around age 103. But you'll see that this really substantially falls if returns are more like 0%, so falling to age 90, pretty close to median life expectancy for women, and really changing our interpretation of how sensible this sort of strategy might be. Thinking about those withdrawing at initial rates of 5%, you can see a similar pattern. So under 3% real returns, they might exhaust their pot at age 93, so well above median life expectancy for men and women. But under 0% returns, they would exhaust their pension pot at 86, so under median life expectancy for men and women. So really substantial differences in outcomes here, and we see similar when thinking about those withdrawing at 6%. So the uncertainty about what asset returns you receive is another thing making active management of pension wealth in retirement really difficult. And it's important to say here, of course, we're illustrating kind of risks weighted on the downside here. There are upsides too, with significantly higher returns possible, but this is very much a risk to which people are now exposed when drawing down their DC wealth. And finally, we know that people risk a significant decline in cognitive ability. And among other things, declining cognitive function will make it more challenging to manage a pension pot actively. Here I'm showing you the average number of words remembered out of 20 in a word test by age and split by people's birth cohort. And you can see that while the average number of words remembered is roughly constant to people's 50s and early 60s, it falls thereafter, and it declines really pretty substantially at relatively older ages. When cognitive ability is declining, this will really increase the difficulty of actively managing a pension pot. Okay, so I'll sum up. So we've thought about the increasing prevalence and the increasing value of defined contribution pots in the past and expected in the future, meaning that the importance of decisions that people make over their DC wealth is set to grow. At the same time, since pension freedoms, people have been able to access this wealth flexibly, and we know that many are not accessing information, guidance, or advice at various key stages of decision making. And we know that a range of risks are faced by people making decisions over their DC pension. So we've gone through the risks posed by an uncertain lifespan, by uncertain asset returns, and by the chance of experiencing cognitive decline. And this all comes together to create multiple challenges when thinking about how to create a system in which people are making good pension withdrawal decisions. And I'll now pass on to Jonathan, who'll talk in a bit more detail about these challenges that policymakers face and the sorts of suggestions we think might help improve the policy environment.
Thank you very much, Bea. I'm just going to share my slides. Great. So as Carl and Bea have said, I'm going to be building on Bea's presentation and presenting our policy conclusions. Now, given the risks that people face in drawing down on their wealth in retirement, William Sharpe, the Nobel Prize-winning economist, called this problem the nastiest, hardest problem in finance. But having undertaken this work, we also think that policymakers face difficulties in developing a coherent policy landscape. And that's because of the wide variation of situations that people find themselves in as they come to retirement, even if they've had relatively similar earnings over the course of their life. We found a wide range of opinions from stakeholders regarding the appropriate level of government intervention here, and also a lack of data that hinders individuals, government, and pension providers' decisions on how to help people. Now, in terms of the conclusions that we come to, a big picture to bear in mind is that we think that these suggestions are going to be reducing the risk that people end up with low living standards, particularly later in retirement, given those risks that B set out in her presentation. There are going to be two parts to my presentation. The first thing I'm going to do is talk about the decisions over retirement income products that people face, and in the future, what kind of products do we think might be appropriate for most people? And in that context, how to help people make good decisions over what's right for them. That's going to be roughly the first half of my presentation, and then I'll go on to talk about what we're calling other kind of parameters of the retirement income system. I'll go into more detail on that, but a kind of overarching theme here is how to ensure that defined contribution pensions are essentially pensions and not just savings pots. So, on to retirement income products. So any conversation about retirement income products has to engage with the key risk, really, that B talked about, which is what happens if you live longer than expected. It's a key risk in retirement because what will happen to you if you run out of private resources? Well, one answer to that is that there is the state pension. And because the state pension is an income that is paid out no matter how long you live, it provides what is termed as longevity insurance. But there's a question. Do people need more longevity insurance than that provided by the state pension? To answer this, the next chart is actually going to show that many people would face large falls in their material standard of living if they had to fall back purely on the state pension. So I'm going to show you actually the fraction of people with private pension income who'd see their disposable income more than half if they exhausted their private resources. So we find that 40% of people, if they were to just fall back on the new state pension, 40% of singles would see their disposable income more than half, and 45% of couples would see their disposable income more than half. That actually rises to almost 2/3 when you consider a couple where the one member dies and the surviving member of that couple is left on just one new state pension. So this implies that many face a significant risk of big falls in their material standard of living, even though the state pension is there. And that points towards steering people towards some form of annuitization or longevity insurance, if they don't already have some. So given this, what do we think appropriate solutions might be for people with DC pensions? Well, we think that a model that's called something like a flex then fix model is likely to be appropriate for many. What's a flex and fix, and why might it be? Why do we think it's probably going to be a good idea for a lot of people? Well, in this kind of model, people would have the flexibility to draw down on their DC pension wealth earlier in retirement, but at later ages, annuitize at least some of it. And that provides a balance, therefore, between the flexibility of being able to spend to some extent, as people like, earlier in retirement, but as people get older, as that uncertainty over remaining life expectancy rises, that B pointed out, and the cognitive decline that comes in for a lot of people, making it harder to make financial decisions, then annuitization provides a solution to both of those risks. Ooh. So the details of any particular product will be important. But it's key to note here that forthcoming pension scheme bills like to require trustees of pension funds to provide default retirement income solutions. And we think that while they will choose those, that this kind of model is therefore likely to be a good option. But with the introduction of default income solutions, we need that some care. We believe that some care is needed because any form of default, pretty much, it can be shown to be extremely powerful in determining people's behavior. And while some form of annuitization is likely to be good for many, that won't be the right call for all people. In particular, people who have significant defined benefit pension wealth, for example, if they've spent part of their career in the public sector, or if they have health conditions which dramatically reduce their life expectancy, then annuitizing is unlikely to be a good idea. And so some people will need help to move away from the path of least resistance, even if that path of least resistance is appropriate for many. We think two approaches are needed here. Firstly, that when introducing defaults, pension providers should try to make them soft. That means that you're not trying to get everybody to stick to the default, but instead you have one default and provide, for example, a menu of other sensible options that people could choose from. Second, we think that some boosting of advice, guidance, or a combination of advice and guidance would be important. And while there's some discussion, debate about the Financial Conduct Authority's support proposals for what's called targeted support, we think that in the long run, it would be good if people could get information that takes account of people's own situation without the need for purchasing expensive ongoing financial advice. So that's the first set of conclusions on the retirement income products for the future and decisions over them. My second part is talking about these parameters of the retirement income system. I'm going to talk about three policy suggestions and conclusions that broadly help DC pensions act as pensions and not just savings pots. And the first thing issue here is that people accumulate many pots over the course of their career. And that's basically because typically every time people change employer, they will typically get a new pension pot. Now, it's been widely debated, at least within the pensions world, the impact this has on the number of small pots. And that's shown here. This is a chart showing the number of deferred, that means not currently contributed to, pension pots worth under £10,000 in 2023. 12 million of these pension pots are below £1,000 in value, and another 8 million between 1,000 and 10,000. But we think in order to make good decisions at retirement, that actually the issue isn't just about the smallest pension pots, but actually ultimately people should end up with few or even one DC pension pot in retirement. Because if they don't, then decisions by either individuals or default decisions by pension providers are going to be unnecessarily hindered if DC pension wealth is spread out across a large number of pots. For example, in extremis, imagine somebody who had £50,000 in one pension pot, and they could make a decision over that, or helped by a pension provider, for example. But imagine now how much how much harder it would be if you had 5 different pension pots, all worth £10,000. Not only would you have to make potentially different decisions over those, but how your pension provider defaults you into doing things may differ as well, would likely differ as well. So how do we end up in a situation where most people end up with a very small number of DC pots at retirement? There are essentially two approaches. I don't want to go into too much technical detail here, but ultimately you could either the government needs to rely on a automatic consolidation of most pots and not just the smallest pots where most of the policy discussion has been focusing, or a mix of auto consolidation for small pots and encouraging people to consolidate them themselves through a simple and hassle-free process. The second issue in this of set of three that I want to talk about is the age at which a defined contribution pension can be accessed. And in particular, we think that the access age should be gradually increased over time. So at the moment, individuals can access a DC pension from the age of 55, and in 2028, that's going to jump to 57. But 57 will still be 10 years before the state pension age, and people accessing and drawing down on pension wealth from that point have a decade to get through to the point at which the state pension comes in, and then potentially decades after that. That's a long period of time to withdraw it. We think ultimately there's a strong case for this minimum access age to be increased to 60 by the mid-2040s when the state pension age is 68. And that helps to ensure that DC pensions are pensions and not savings pots for people to dip into later in working age life. Indeed, there's actually a case to go further. By the time you got to the mid-2040s, life expectancy at 60 is set to be still significant. 26 years on average for men, 29 years on average for women, and that's still a long period over which to withdraw a pension. But it is challenging to go further than 60, we think, as many people retire in their early 60s in comparison to people's late 50s, when relatively few people do, and pushing it further above 60 would ultimately begin to affect people's actual retirement decisions more. So that some care and thought would need to be done if going further. The last point, we would like to avoid using the word lump sum when framing the tax advantages of private pensions. Well, what you wonder what am I talking about? Well, I want to remind you that individuals can withdraw 25% tax-free from their pension in a wide variety of ways. That can be you take out 25% of your pension pot, and that 25% straight up as a lump sum is tax-free. But it also, for example, it could be that every single withdrawal from your pension pot, 25% of each withdrawal is tax-free. So there's a wide variety of ways that you can get those tax benefits, that tax-free element in withdrawing pensions. But almost all the conversation and discussion about this is about the apparently tax-free lump sum. So if you go to Google and you type in tax-free pension, the first hit is gov.uk. And you look on what gov.uk tells you about the tax-free part of your pension. And here's a screenshot of the top of that page. And you can see here that in the matter of a few lines, gov.uk is telling you about the tax-free, about the lump sum, 1, 2, 3, 4 times. Why am I laboring this point? Well, we're concerned that this terminology and the framing about the tax benefits of private pensions are inappropriately steering people towards taking 25% tax-free up front rather than in a more smooth manner. And it's all very well thinking about exactly what of your withdrawal rate should be, 4, 5, 6%, for example. But if you take 25% straight up, that's a big decision. What do we think would be better? Well, we think it'd be better to discuss this in a different way, to frame it in a different way, and frame this tax advantages as tax-free withdrawals or a tax-free element. I'll conclude. We think it needs to be easier for people to make good decisions about how to draw their defined contribution pensions. They should not need to be experts to do this well. And given that, many people need to be steered towards solutions, and particularly solutions that provide some insurance against living longer than expected. And we think that these kind of hybrid flex and fixed models are likely to be good for many. But with default retirement income solutions coming in, others are going to need to deviate from the path and from this path of least resistance and potentially help doing so. Finally, the King's speech stated that the government thinks that people should have a pension and not just a savings pot. We agree, and therefore we think that there are three changes that need to be made ultimately to help do that: consolidating pots, raising the minimum access age, and changing the framing of tax-free draws. I'll now hand over to Paul Todd from Nest to give his insights and comment.
Great, thanks. Hopefully I'm sharing my screen. Is that coming through?
Not, it is now.
Excellent. Well, thank you very much for having me. And I thought the draft of the report I've seen was excellent and very timely. I'm just going to talk a little bit about the specific Nest experience and the work we've been doing to try and address the problem, as has been highlighted, is one of the hardest things for people to do, particularly for people to do on their own. But just a little bit of background about Nest. We have 13 million members. Predominantly our membership is are people who are on lower to median income. So the average salary for our membership at the moment is about £24,000. Most of our members have a heavy reliance on the state pension. That's our expectation when they get to retirement. It's very unlikely from the research that we've seen that our members will be looking for formal financial advice. And even if they were, whether or not they could be served well by the financial services industry at a price point that would make sense. So we've had a lot of concern about how our members will start accessing their savings pot, because we agree with the IFS report, the savings shouldn't be about building up a pot of saving. It should be about an income in retirement or a wage replacement. Our membership, the average age is around about 46, but we already have over 2 million members who are aged over 55. So this is a challenge for us that's coming up quite quickly. So one, we need to think about how we invest their money as they approach retirement, and then how we're going to support them in turning their savings into a sustainable income. So we've been doing a lot of work on this since 2015 and the changes to compulsory annuitisation. And broadly speaking, we have kind of 4 principles that we think make sense for our membership. The number one thing in all the research that we've done, and I think it aligns well with the trustees' fiduciary duty, is that our membership on the whole are looking for a stable income for life. The second thing is, though, and the obvious thing for that would be, well, why doesn't everybody buy an annuity? And as the IFS report has set out, that's unlikely to happen in an uncompulsory regime. And there are many reasons for that. So if people aren't going to annuitize at 65, and economically we would suggest that's probably not the best solution, how do we get the highest possible individual income to members, and how do we front load that early on in their retirement? And we want to see this as about exhausting people's savings, not building up legacies to pass on to their estate. Whenever we've kind of surveyed our members, and bearing in mind their pots will be relatively modest compared to people who've saved in DC kind of traditionally, we want to get as much money to people early on in their savings career and have that used as efficiently as possible. And as IFS has said, the ability to be flexible, certainly early on in your retirement journey, is incredibly important. There's a huge value that our members put on that. But I think if solutions are default solutions, having flexibility for as long as possible without giving up too much of the upside that flexibility can do, and will be incredibly important for default solutions, particularly when we're trying to provide a default solution for potentially millions of savers. And then the final point, which I think was highlighted in the IFS report really, really well, is when you're starting, if you are defaulting people into solutions where it's difficult to reverse that decision, so by entering a mortality pool or somebody having a crystallization event, you need to be very, very, very careful as a provider or as a trustee that you're trying to get as much information and communicate as well as possible to members before they get to that point. So I'll just talk a little bit about some of the kind of practical areas that we're trying to develop and we're looking to introduce over the next couple of years. So our default solution is an income strategy that serves a member for life. And basically what we want a member to see is a steady, sustainable income that grows with inflation where that's sensible and reasonable. And then later on in their kind of savings, in their retirement career, there's a degree of certainty and security as they get older. So there may be complexity sitting underneath this, but what we want a member to see and what from our research our members expect is a steady, lifelong income that grows gradually and then provides security as they get older. How do we deliver that? So in line with the kind of flex and fix approach that the IFS report sets out, this is the way we've been thinking that would make most sense for our membership. So I think the first thing to think about here is that the vast majority of people's savings and time will be spent in an invested solution. So this flexible income accounts, which is the blue the blue block at the top, that will be invested in capital markets, an investment strategy set by the trustee, aiming to throw off a regular sustainable income for approximately 20 years. And those ages at the bottom are likely to kind of change around as our membership develops and as our understanding about our membership needs develop. But broadly speaking, we're thinking the first sort of 10, 20 years would be super flexible and invested, and the last 10 years would be provided by some kind of collective risk sharing or mortality pooling. And the concept of monthly payments that are kind of set aside for the first 10 years, which then secure a later life income, that tested really, really well. The aim here is to provide complete flexibility for the first 10 years, reduce some of that flexibility for the next 10 years, and then have much less flexibility for the final 10 years to reflect the expected kind of life journey our members will go through. And that can be delivered in a number of different ways. I think conceptually, the way we've thought about this is not dissimilar to our approach to target date funds. So if we think about a retirement income cohort of 2026, their fund would be invested in underlying building blocks. This would be visible to the member if they wanted to see, but this is the sort of plumbing that sits underneath what a member would see in terms of a regular income being paid out to them. And this would be a mixture of kind of liquid cash, an invested income account, and a later life protected income. And those are the kinds of proportions that we think we would set for members. The liquid cash account that could be anywhere up to 10%. This is trying to address the point in the IFS report about this focus, and I think we would agree, an over focus on people taking out a 25% cash lump sum. We definitely recognise that people want some flexibility and need some liquidity, particularly as they first start their retirement journey. But whether or not 25% that's being taken out and then sometimes just put into a cash account is necessarily the right thing to do, bearing in mind the impact that will have on retirement incomes, we have some concerns. So we'd be interested in in kind of nudges to encourage people to take a higher income, and then if at a later date they needed to access more cash, having that available without having to upset the regular income. In terms of the later life protected income, which is the bit of the sort of the end of the strategy, we've identified a number of ways that could be delivered, and I've highlighted one at the bottom there, deferred annuities. But equally, this solution could be delivered through potentially the new decumulation CDC legislation that might come forward in the coming years, or potentially, as we're seeing in the US, schemes creating their own internal mortality pool. The challenge for those last two ones is you do need scale, and as we're seeing, say, small number of members coming up who will need this solution in the early years, and then followed by kind of much greater numbers later on. So finding optimal ways of delivering this in the short term, which then may lead to different solutions in the long term, I think is also a challenge that schemes are going to have to develop. It would be much easier if everybody was turning up with large pot sizes and you've got hundreds of thousands or millions of people in one go. That's just not the reality of automatic enrolment. And then just the last slide that I'll just leave people with is the importance that we see around the kind of trustee duty and the fiduciary duty. So that quote earlier on about this being one of the hardest problems in investment, we think it's particularly unfair to place some of these decisions on our membership. And as I said earlier, we don't think they're going to get access to high quality, low cost financial advice, which is what they would need. So how can we kind of wrap the kind of fiduciary duty of the trustee around these decisions, much in the same way as we do with the accumulation phase? So it's our belief that the trustee should be making the decisions on behalf of the membership through a default strategy that people can opt out of on how savings should be invested, how you purchase some form of mortality pool, whether that's deferred annuities, or creating some kind of internal mortality pool. And importantly, what is a sustainable rate of income drawdown throughout that time? And that shouldn't be a one and done. That should be revisited at least every 12 months to ensure that particularly that invested part is being managed to support that steady, sustainable income for life. So I'll leave it there, but happy to answer any questions on this.
Thank you very much, Paul. Thank you very much, Jonathan and B. So we'll now move to the question and answer session. Do post questions on Slido. Do vote for the questions you think are particularly good. I will try and choose largely from those towards the top of the pile. There's lots and lots of questions coming in. Thank you for those. We'll come back to the one at the top in a bit. I think I'd like to turn to the ones around correlations between pension wealth and life expectancy. There's also a couple of questions about cognitive decline and people's expectations of longevity. So, Jonathan B., perhaps you can touch on what do we know about levels of numeracy amongst those approaching retirement, people's awareness of their longevity, and what that's correlated with. Perhaps B, you can have a first stab, and then over to Jonathan.
Sure. Yeah, so I think it is right to say that we know that levels of numeracy are pretty low even before any kind of cognitive decline that people experience. We know that currently people with a DC pension are more numerate than average, but there are still kind of relatively low levels of being able to answer questions about things like compound interest correctly. And of course, we don't know how that difference in numeracy will change as we see more people who've been automatically enrolled into a DC pension reach retirement. But of course, cognitive decline is going to make lots of these decisions much, much harder. In terms of what we know about people's perception of their lifespan, we know that particularly at early points in retirement, people on average do tend to underestimate their lifespan. and work by others at the IFS have suggested that this might be one important reason why we see people relatively reluctant to buy an annuity post-pensions freedoms, is that these appear to be worse value because people that think that they will live for less long. Don't know if you want to add anything to any of that, Jonathan.
Yeah, I agree with all of that. And just to develop the questions on Slido, you know, in general, richer people have built up higher private pension wealth. They tend to live longer. They tend to have that risk of living much longer. But it's not only richer people. Um, um, it's not entirely true. There are groups for which it goes the other way. For example, women live longer than men, but women have built up less wealth in general. I guess the overall point here, though, is that I would want to say is two things. One is, um, people with big amounts of private pension wealth, big DC pension wealth, of course, they're going to, almost by definition, if you've got a lot of wealth, you're wealthy. And so, these are higher stakes decisions for, on average, slightly wealthier people. But over time, the breadth of automatic enrollment is going to mean, and that's something that B was trying to get across, is that, the breadth of automatic enrollment means these decisions are becoming more important for a broader set of people, including, people on lower incomes through their life.
Thank you, B. Thank you, Jonathan. So there's a question here I'll put to Paul and then Jonathan about, I guess it's getting at complacency and kind of how urgent is reform in this area. On the one hand, I think B's just told us that DC wealth is going to be a lot more important in the future. Many current retirees perhaps have some DB wealth. Perhaps they've got some longevity insurance then. But on the other hand, Nesta's been around quite a while now. We're 10 years on from pension freedoms. Uh, I guess the questions get, is it bad that we didn't do more 10 years ago or 5 years ago?
Yeah, I think it is urgent. I think when we see the number of members that we've got over the age of 55, and not many of them have got huge pots, but some of these pots are getting quite large now. And when we've researched into our membership, even pots as low as £10,000 and demonstrating what kind of income that would throw off, people do say that would make a difference. That's a genuine difference in their lives on top of the state pension. It's the difference between being able to put petrol in the car. It's the difference between, occasional treats. This is not about, for our membership, cruises and things. This is about kind of raising standard of living a bit. So getting things in place that meet their needs feels very, very pressing at the moment. And it is surprising how little innovation has happened since freedom and choice came out in 2015. But we're not alone in this. When you look at the Australian market, where people talk about them being sort of 10, 15 years ahead of the UK market, they've got exactly the same problem. So they've done a great job on getting people saving and accumulating, large pots of wealth. But are a long way from having a sustainable system that helps people turn that into reliable income. And the big issue in Australia is people ending up at 85 with more money than they had at 65 because people are terrified of spending their money. So a big part of our solution is making people feel confident of spending their money early in their retirement without having to worry about it running out. So that was the sort of second principle, is get the money to people as early as possible, but make sure that there are safeguards in place to prevent exhausting all saving just because you happily managed to live longer than expected.
I basically agree with a lot of this. I mean, in 2015, automatic enrollment was in its, nascent. It was only just born. Not everybody was automatically enrolled, and a lot of DC pensions people had in addition to a big those who had them in addition to DB pensions, which are already providing a lot of security. And, you know, as everything that B showed, you know, we are on a trajectory towards kind of, you know, DC generations. And so I think we really need to start getting this the kind of house in order so that we don't end up in 10 years' time in the same place.
Right. So there's a couple of questions about the tax-free lump sum, which I'll abuse position of chair and answer myself. And the questions are really around, should we just be reforming that, getting rid of it, changing it in a more fundamental way? At the start of 2023, we concluded a project looking at the pension tax system. And one of the proposals we had there was around the tax-free lump sum, where we questioned why people with, say, £900,000 pension pots should be getting a tax subsidy on additional pension saving. They don't look like they're under saving for retirement. And we questioned why somebody who was a higher rate taxpayer in retirement should benefit at a higher rate from this subsidy than someone who's a basic rate taxpayer in retirement. So if you have a tax-free lump sum, it is worth more to you if you're a higher rate taxpayer than if you're a basic rate taxpayer. So that report, which is on our website, does have some reforms there that we proposed, essentially replacing the tax-free lump sum with a government top-up to every withdrawal from a pension, a top-up that would be taxable, but it would be a flat rate. I think it's fair to say that that didn't go down with unanimous approval. I think it's fair to say that the tax-free lump sum is one of the perhaps higher profile parts of the attractiveness of saving in a pension. Even if people don't fully understand it, they are attracted to it. And to be fair, it's also been relatively enduring, and we do want our pensions tax regime to be stable. So that reform has not been well received, I think it's fair to say. Alongside that, though, we did say that if somebody wanted not to go the whole hog and do something different, you could just cap the tax-free lump sum. Jeremy Hunt then chose to do that, so there is a cap. You can only get the tax-free lump sum on 25% of I think the first £1.08 million that you have in a pension. My view is that that is good that we have a cap, but it's too generous. And indeed, in that report, we gave an illustrative example of a cap of £400,000, which would still mean that people could take out a six-figure sum completely free of income tax. It would mean that the majority of people who worked in the private sector would be unaffected by that cap. They don't get pensions of that size, although it would hit a lot of public sector workers. So we have proposed more radical reform on that previously. In today's report, we're not talking about tax system. We're not proposing a change there, apart from, as Jonathan said, a rebranding, call it a tax-free element rather than a tax-free lump sum. Get rid of those words lump sum. Don't encourage people to take 25% on day one inadvertently. There's a couple of questions about annuitization. One pointing out that pre-2015, you could get away, you didn't have to annuitize if you had a sufficiently high guaranteed income, essentially suggesting, should we just go back to that? Should we just have compulsory annuitization of DC pots for most people and only let those who know that they've got a secure income, who can prove that they've got a secure income, opt out of that? Perhaps Jonathan and then Paul can have a go at that one.
I think there's two reasons broadly not to go back. One is a pragmatic kind of reason is I don't think that there is any political appetite to kind of put pension freedoms entirely back in the box. And I think that it is important for us when we're reviewing these systems to take into account what, you know, the potential direction of thoughts of policymakers from different parties. You know, that's not just one party. I think across parties, there's not really a desire to put them back in the box. So that's one thing. Secondly, I think, you know, there's just this point that the value of annuitization rises as people get older, and just the value of it is much higher for somebody, say, in their 80s than somebody in who's 65, and the uncertainty over longevity about people in the first 10 years of their retirement if that starts in the mid-60s, isn't that high. So I think that, and most people, don't, suffer cognitive decline in that period. So I think the case is really is a kind of pragmatic one, but also the rising value of annuitization as people get older points towards this kind of hybrid solution.
Yeah, the only thing I would add to that is I think we think annuity it's a good product for the kind of specific purpose of ensuring that if you live longer than expected, that somebody will stand behind that. I don't think it's a good income solution for a 65-year-old who's then got another 20 or 30 years worth of potential for investing and drawing down. It's just uneconomic. So I think in our view, being able to put that capital to work for much longer means people will have higher pensions. They may not have the same certainty, but when we've researched with our membership about what they want, when they talk about a sustainable, dependable income, they're not talking about a guarantee, a Solvency II guarantee with capital backing there. They're talking about high probability. So in our solution, it's possible that incomes may need to be cut if they're not sustainable because market performance has been poor for a long period of time. But that tested, people preferred the potential for a higher starting income, even if that meant that would have to be cut at some point further down the line versus a lower guaranteed income. That kind of changes, I think, as people get older and people get more used to kind of retirement. But then back to the cognitive decline point, you want to get people, if they are going to engage and make these decisions or about whether they should stay in a default solution or opt out, I think it's important to have that conversation early on before cognitive decline kind of kicks in. Whereas if we waited until 75 or 85 and then asked people to make a choice about purchasing an annuity, I think that's even more challenging. I mean, it was challenging enough, people trying to make a choice about and shopping around for annuities at 65, asking people to do that at 75 or 80, I think is increasingly unfair. So if we can have a sort of a hybrid solution that's taking into account a lot of these behavioral things, is taking into account the economic benefits of investing for longer periods, and using kind of annuities and mortality pooling when they make the most sense, which is later on, and that feels like we're getting the right blend.
Great, thank you. B, then Paul, there's some questions about sort of spending need through retirement. I was sort of struck by Paul's example where somebody would have a fixed real income for a lot of their retirement, then a fixed cash income later on. The question in the slide I was really asking about whether people have sort of much bigger needs to spend early in retirement, expensive holidays, much lower need to spend later. And perhaps B, you could start by sort of setting out what IFS analysis in this area has previously shown, and then perhaps Paul, you can talk about what Nest have done in this space and why the profile that you've came up with.
Sure, yeah. So as you say, Carl, in previous work that we've done here at IFS on kind of how spending changes through retirement, we don't find strong evidence that there is a kind of strong decline in spending through retirement. In fact, we find spending is pretty flat in real terms through retirement, although the composition of spending does change with age, as you might expect. So things like spending on household services and bills go up at later ages, and spending on other things, motoring or holidays at much later ages, kind of tends to decline. So that's what we've done at IFS. Cool.
Just to contradict it. So the research that we've done did see, so we definitely don't see a U-shaped consumption curve where it starts off high and then it goes down and then it goes up again. We think that was a bit of a myth, or maybe had more relevance in places where healthcare wasn't necessarily provided for free. So we've seen, the research that we've seen shows a gentle decline in consumption patterns from to sort of early 60s, and it gets and gets lower, and then also across different income deciles. So I think trying to hedge inflation from 65 all the way through to end of life is really, really expensive. So the main way of trying to hedge inflation we're using is through kind of investment returns. So the idea of paying a real income increase each year, it'll be on a best efforts kind of basis, and that will be some of the kind of safety valve, which is not dissimilar to debates about CDC. That there'll be a kind of a rule set that if investment performance has been reasonable, then you'd expect to pay an inflationary increase. When it comes to the sort of deferred annuity or the mortality pooling, we think the sort of flat rate makes more sense, mainly to my earlier point about getting more money to people kind of earlier on in their retirement. And also when thinking about our membership, they are getting a lot of inflation protection through the state pension. So it's trying to think of that holistically. So certainly for the next 10, 20 years, the majority of our members who are coming to retirement who don't have DB elsewhere, and that is the majority of them, most of their kind of savings will come from the state pension, which has got very good kind of inflation protection. So building in inflation protection on this kind of top up felt it was over engineering things, but this is the kind of thing that I think, because this will be built on a cohort by cohort basis, that we can revisit that, and we can change that over time.
Yeah, I think that the point there that it may well be changing across successive cohorts is a very important one. As B showed, well, today people with substantial DC pots are a particular type of person. For example, they may be disproportionately self-employed. They may well have been saving in a DC pot since the mid 80s. Whereas in future, even those who spend a lot of the years of life working on full-time on the minimum wage could have quite substantial DC pots. We know there are trends in particular in home ownership, which means that in future we're going to see a lot of people in the private rented sector throughout their retirement. And of course, their spending patterns may well be quite different to owner occupiers. And indeed, there may be a big difference by whether their rent is being in part or fully covered by housing benefit, or whether they're having to meet that through their accumulated DC pension wealth. Rents may well be something which are going to be rising through retirement rather than something that will be flat in cash terms or falling. So I think it's certainly something that's going to need continually to keep an eye on, and may well be quite different for different types of individuals. Jonathan, the top question in Slido, the concern here, I think, is that people get to later in retirement, maybe long-term interest rates at that point are particularly low because of some shock, and then it makes annuitization at that point really quite sort of expensive. And is it right that sort of new retirees should be exposed to that kind of annuity risk for the first half of their retirement?
Yeah, thanks, and I'll be interested to see what Paul thinks as well on this. I mean, in our report, we show that if you are starting in a flexible drawdown and you're drawing down, and the later you annuitize, essentially there's a longer period over which you're facing investment risk, and that includes interest rate risk. There's kind of two caveats. So I kind of appreciate the kind of point of the question, and that's something we discussed in our report. I think two caveats to that. One is, I think it depends on whether you're buying a deferred annuity, or whether you're ultimately buying a annuity at a later point. And secondly, you've got to think about what's happening to the value of the assets as well. So if you're in a lot of bonds and interest rates fall, then bond prices tend to rise, and so you've got a rising value of your investments, and then you're also getting a less good annuity rate, but the actual income that you might get doesn't change as dramatically as just the kind of what the annuity rate would suggest. I don't know if Paul has anything to add. Hopefully Paul agrees with me, but also whether Paul has anything to add on that.
Yeah, I do agree, and I think I mean part of the challenge of compulsory annuitization at 65 that's a lot of forecasting that needs to go on by the insurance industry about trying to work out what markets are going to do, what mortality is going to do for the next 20 or 30 years. Having solutions which are trying to blend the best of both worlds, so invested solutions and mortality pooling and turning those bits on at the right time without being too overly hidebound about when that should happen. So I think the beauty of what we're trying to do is that it doesn't have to be 75, that it could be 76 or 77, and we'll have time to adjust because each year we'll be reviewing for this cohort, is this a sustainable rate? Should we be locking in kind of more security through the investment strategy or buying the deferred annuity or something a little bit earlier? So having that kind of flexibility, but also seeing a deferred annuity or some form of mortality pooling as just another kind of asset class within a diversified portfolio, I think provides a much more flexible solution. So it's not just about flexibility for the individual to change their mind and go do something else because they know their personal circumstances better than anybody else. It also allows us the flexibility to not be all of these things have to happen at this time. This asset allocation has to be exactly the same. I suspect we'll be changing asset allocations for different cohorts at different times, depending where we are in economic cycles. And I think in that way, we can start kind of managing more effectively interest rate risk, inflation risk, mortality risk in a more dynamic way. Having said that, we do want to give people some predictability about what's going to happen at different times, particularly if we're entering somebody into a mortality pool as a default solution. It's very, very important that we give people a lot of information up front because our nervousness, which is our fourth principle, is the potential of putting people who have impaired life or all sorts of reasons into something that's just that pretty quickly and pretty obviously wasn't suitable for them. So getting that balance right between flexibility and dynamism whilst being able to have a very clear communications message about these things are going to happen to you at this point. And if at any point you're not happy about it, this is the kind of exit ramp, I think is key to the success of these solutions.
Thank you. So there's a couple of questions about inheritance tax on there. The change here that people are talking about is, I think it's from April 2027. When you die, your DC pension wealth will become part of your estate for inheritance tax purposes, whereas up until that date, it was completely ignored, which led to the rather odd situation where DC pensions are actually more tax favoured as a bequest vehicle than they are as a retirement income vehicle. One of the questions is really around someone needing financial advice and whether it's better to use a pension or an ISA. I suspect that answer depends on a whole load of things like your income tax rate, whether you expect to live for 7 more years, etc., etc. I'm not going to get into giving that advice. The other question involves public sector pensions, where DB arrangements, where there can be survivor benefits, which are not subject to inheritance tax when someone dies, and that makes them look even more generous relative to DC pensions, which typically private sector employees have. That is true, although I'd make the point that in the vast majority of cases, when a public sector worker dies, the survivor benefits are paid to someone who they are married or civil partnered with. And if you're in a DC pension or indeed in any other type of savings, if you leave your money to someone you're married to or a civil partner, there's no inheritance tax either. So in the vast majority of cases, I don't think there's really a difference being driven by the inheritance tax system here. Of course, it remains the case that public sector employees enjoy employer pension contributions, which are very big relative to what the vast majority of private sector employees can get. So we've now reached 11:15, the end of our allocated time. Lots of really great questions. Thank you very much for all of those. Sorry we couldn't get to answer more of them. just to remind you again, July the 2nd, that's the launch of our main report from the Pensions Review. All the materials will be available on our website at that point. Do look out for that. Big thank you to both Bea and Jonathan, and especially big thank you to Paul Todd from Nest for joining this webinar. And that's all from us. Goodbye.